Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring Live. And today I wanted to do a video about the importance of adjusting your position size based upon increasing or decreasing volatility. Last week in my daily live stream, I had one of the members ask me, Greg, I know you talk a lot about reducing your position size when volatility increases, but when do you know when to increase your position size back? And I told him, I said, I usually take a look at the ATR channels. When volatility is low, they're very tight. When volatility increases, they expand. And I said, when they start tightening back up, I'll go back to a larger position size. But I thought about it and thought, that probably wasn't too much of a satisfying answer. And so what I want to do tonight is on this video, I want to give you a formula that will very precisely, based upon the change in the volatility, tell you exactly when to increase your position size and by how much. For many years, I've used a 5% emergency stop for my emergency stop on any position. And when volatility is low, that's fine. It gives you a lot of room on especially the type of stocks that I trade that don't have that kind of range. But in this recent market volatility, we've had such an increase in the range of days that a 5% emergency stop may not actually calibrate and take into consideration the large moves of the day. So what I'm going to do tonight in this video, I'm going to go through and I'm going to talk about, the importance of reducing or increasing your position size based upon the volatility. I'm going to show a formula exactly how to do that. So anyway, I hope you're going to find this helpful, and let's get started. So volatility has increased four times over what it was a few months ago. Have you decreased your position size by 75%? If you have not, your risk exposure has increased by 4 times. So back in the past, if you used a 400 share position size and now you're still using a 400 share position size while volatility is increased by 4 times, you 4 times the risk that you had when volatility was low. So something to keep in mind, right? Let's take a look over here. Okay. When volatility increases, so does your risk. We need to standardize or keep the same our maximum loss per trade regardless of the market volatility. So, ideally you have to come up with, hey, what is going to be the maximum amount I'm going to lose on any one trade? A lot of people use the guideline of I'm going to risk 1% of my entire capital on any one trade. And that's fine. I prefer to use about 0.5% of capital. So I'm a little bit more conservative. But the important part is that, we're risking, let's say we have $100,000, we're risking 1%, we're going to risk $1,000 on any particular trade, whether the market volatility is low or whether the market volatility is high. We still want to risk that $1,000. The difference is going to be in the amount of shares that we trade relative to what the volatility is. And I'm going to show you how to do that in a while. We must adjust our position size down when volatility increases and adjust our position size up when volatility decreases. It is very important. Let me take a look over here and I'll show you. All right. Here is a chart of United Airlines. Well, you can see here are my ATR channels. Here's the 6th, 5th, 4th, 3rd, 2nd, 1st, and then we have the -1, -2, -3, -4, -5, -6. When I look at volatility, when I just kind of do it off the top of my head, I look at how wide these channels are from each other. And you can see here, they're fairly wide. If we go back over here before this all started, you can see they're fairly narrow. So as volatility increases, I can just look at the difference between this ATR channel and this ATR channel compared to this ATR channel and this ATR channel. And I can just obviously look at that and just say, look, I know volatility has increased. But I want to give you a way that's just very, very specific, that will adjust every day what your share price is, and it's just a good solid black and white formula to use. Now, what's important is, you see the range here between this ATR channel and this ATR channel? That's called the average true range. That is what is average. That is what is to be expected. It's considered noise. So you want to have a stop, your emergency stop, it should be outside of noise. It should not be within this value from here to here, because that is just noise. So I want to use a value that is more than this. And as we go further in here, I'll show you that's why I'm using 2 ATRs. All right, so let's take a look over here. So what I was just talking about, true range, measures the distance from the low of a specific daily bar to the high of a specific daily bar. And why that's important later on, I'll show you in this formula. But again, over here, you can see here where the bars are very narrow, there's not a lot of range. That is why these ATR channels are so narrow. But as the price has increased dramatically, the ranges, that meaning the movement in the day, that is what's making these ATR channels widen and widen and widen. So there we have true range, and we have average true range. So average true range, ATR, is an indicator measuring the average market volatility of a security, whether that's stocks or bonds or commodities, anything, based upon a specified number of days. In other words, a moving average of individual true range bars. So again, I have this set here for, let me take a look over here. Oh, got ahead of myself there. So I base my ATRs on 20 days. So it's going to take the average range of the last 20 days and give me that average price. So as volatility contracts, I'll be using more shares, and as volatility expands, I'll be using fewer shares, so I can get that standardized loss, whatever the market condition is doing. Okay. So let's get to the formula. So step one, calculate your maximum loss on any one trade. So this is subjective, right? There is no right answer here, but like I said before, a good rule of thumb, maybe 1% of your capital as your maximum loss on any one trade. I prefer 0.5%, but for this example, let's go with 1%. So your total capital is $100,000, let's say. Maximum allowed risk on any one trade, 1%, right? So 1% of $100,000 is $1,000. So regardless of whether you have $10,000 or $100,000 or $1 million, you have to determine the maximum allowed risk for any one trade. And like I said, 1% is fine, 0.5% is fine. I know traders that will only risk 0.25% on any particular loss. But for this example, let's just use 1%. Then what you need to do is you need to divide the value of a 2 ATR reading. Some people use 1.5, gives them a little less room. Some people use 3, gives them a little bit more room. But I've chosen 2 ATR. So divide the value of the 2 ATR reading into your max loss. So if my max loss is $1,000 based upon the previous slide, and the reading on the 20-day or the 2 ATR based upon 20-day reading is 4.6. So you just divide that 4.6 into the $1,000. It will tell you to buy 217.39 shares. Of course, we can't buy partial shares, so I would just round down to 217. So if we go over here, you can see this here on UAL, you can see up here at the top, average true range 2 equals 12.09. So what that means is that the 1 ATR is actually 6.045. So it's expected to move basically 6.04 on any particular day. But because this is for an emergency stop, I want to place it outside of the range. So I'm going with 2 ATRs, because if it moves 2 ATRs, it is really strong, either to the downside or to the upside. And if it moves 2 ATRs, then I know I'm obviously wrong, and I would hit my emergency. I would hit my emergency stop. Let's go over here to CCL. This is Carnival Cruise Lines. You can see let's just over here, the distance between the ATR channels is about this big, but you can see a lot of these bars are much larger than 1 ATR. So, you know, if you were going to take a position in here, you couldn't give it a 5% position size. You couldn't even give it a 10% position size, right? Because the average range is on like 30 here on this day. The range was 34% in one day. Here it's 27. Here it's 31. So how could you possibly trade a Carnival Cruise Line using a 5% position size? Because 5% a 5% maximum stop loss, because a 5% maximum stop loss could just be half an hour's worth of the move. So 2 ATRs will take into account the volatility and double that, so that you can take a position size based upon good information that you're going to be outside of the range of just the noise. Okay, so I want to show you, this is just the code that I use in Trade Navigator, which is the software that I use, but any software platform will have this. Moving average 2 times the true range of 20, and that is where I get this number right here. All right, so let me show you an example. Here's Apple. Example number 1, low volatility. This is on June 17th, 2009. The entry signal was a 1050 EMA crossover. So let's go over to Apple, and here it is. All right, so here's my crossover, the 10 crossing over the 50. So if I'm going to get in on this particular day, remember, let's say I want to risk $1,000 on that trade, right? So that's just a personal preference, something you have to come up with. I wouldn't go much over 1%. So, okay, there's the $1,000 that I wanted to risk on this particular trade. Well, then I go over here and I look at the ATR. This 2 times ATR is 8.7860. So just basically 8.78. So you remember the formula. 1% maximum loss, 8.78 is the ATR that I just showed you on the other screen. So I take $1,000, divide it by 8.78. It's telling me to buy 113.89 shares, or I round up to 114. So that basically means if the price moves against me by 8.78, which is well out of noise, right? It's definitely telling me I'm wrong. So if my 114 shares move 8.78 points, I will lose the $1,000. But this is low volatility, right? This is low volatility, and I'll show you. But you can see that the bars are pretty close together, so forth. But all I have to do is look over here at my ATR, my 2 ATRs, and I know I take the $1,000, I divide the 8.78 into it, and it gives me, it kicks out here how many shares I'm going to buy. Now, that was low volatility. Now let's go to high volatility. Keep in mind, the low volatility had an 8.78 average true range, right? That's 2 times the average range. Now, if I go over here to a very recent entry, this is a different entry. This is a 5 crossing over the 20. Now look at the ATR, 2 ATRs. It's 33.53, or the other one was 8.78. So it's like 4 times as volatile. And all I have to do is look at the reading here, 33.53 So I'm using the same $1,000 stop loss, right? And then I divide the 33.53 into that, and it tells me to only buy 29.83 shares, which I'm just going to round up to 30. So exact same stock, but in the previous, when it had low volatility, taking my $1,000, dividing the two ATR into it, at that point it told me to buy 114 shares. Now with the high volatility, it's telling me to only buy 30 shares. I'm still risking the $1,000. I'm still risking the $1,000 on both trades, but I'm adjusting for volatility. So I hope that makes sense. Now to the upside, if volatility starts to contract and get smaller, then my position size will start to go up as volatility increases, and then my position size starts going down. And the main reason, and I want to reiterate this, is that I'm using this for my maximum daily stop loss. Very rarely am I going to hit that, but I certainly could hit it. I've hit it quite a few times in this this volatility that we've had. But you want to have your maximum stop there as protection, but you want to, you don't want to be able to hit that thing all the time. So you want to put it far enough away. But when you do hit it, you want to know exactly how much you're going to lose, and that's why I'm saying decide what your maximum loss is going to be. Use that amount, divide the 2 ATR channel reading. In this particular case here, it's 31.32, and it will show you how many shares to buy. When volatility reduces, your share size will go up because there's less volatility. When volatility gets greater and greater and greater, it's going to keep reducing your position size down so that you can keep that maximum loss just standard. But like I said, I wanted to do this video because someone in the chat says, Greg, how will you know when to start adding on more position size? And just from experience and looking at the ATR channels, I just kind of do it intuitively. But hopefully you can use this approach, taking your maximum loss, dividing into it what the reading is for 2 ATRs, or 2 average true ranges, and then it'll just kick out a number, and regardless of volatility is high or volatility is low, you'll always lose the same amount, unless you have some gap through or something, but we're always up against that. So anyway, I hope this is helpful. I do have a podcast or a daily live stream on YouTube each day where I trade live each day. We talk about all this kind of stuff. I'll be mentioning this in the live stream. At the end of the day, if I find a good setup, I'll go ahead and buy the setup after the market closes. I'm happy to answer any questions that you have, discuss anything, any trades that I have, why I took them, what my thought process was, if you need clarification on anything. If you want me to take a look at any stock symbols, I'm happy to break it down. But we do a lot of stuff in the live stream, all sorts of different setups, talk a lot about trader psychology. Position sizing is extremely important. So if you haven't visited us, it's Gossett Trading. And we're in the last hour of the market. Here's my YouTube channel, just Gossett Trading on YouTube. If you come by, take a look at some of our past live streams, take a look at some of all the lessons I've done on the different kind of setups and phase outs, entry triggers and exits, all that kind of stuff. But feel free to come to the channel, take a look at it, make some comments, and come to the live stream and join us. I think you'll really enjoy it. But again, I wanted to do this video just to give you a very concrete and precise way to adjust your position size based on volatility. Reduce position size on the way down, larger position size on the way up, so you can standardize your position size and your maximum, or standardize your maximum loss. So anyway, hope this is helpful. If you have any questions, please let me know, and hope to see you in the live stream Monday through Friday during the last hour of the market. Thanks so much. Have a good one. Bye-bye. U.S. government required disclaimer. Stock, options, futures, and Forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.